Hi everyone, welcome to this month's financial markets report. Well, it was a pretty challenging month for investors through January. We saw some pretty significant sell-offs in equity markets as well as bond markets throughout the course of the month. Our local equity market was down over 6%, whilst we actually had domestic small caps were down over 9% throughout the course of January. So some pretty significant moves in that context. Global markets weren't spared either. We saw markets down anywhere from sort of 2 to 5% depending upon the currency exposure. And bond markets were again sold off throughout the course of January, and that was on the back of quite some significant moves in bond yields, particularly at the front end of the curve as investors really began to anticipate that central banks were going to start to aggressively increase cash rates throughout the first half of this year. And we really saw that on the back of some significant CPI prints, with inflation now running in the US over 7% on an annualised basis. From that perspective, the likelihood of the Fed actually starting with a 0.5% rise in official cash rates in March really now has got financial markets focused around that. And it's our expectation that we do believe that the Fed will aggressively start to move rates higher. And as I said, that had a flow-on implication for financial market performance, particularly equity markets. And parts of the equity market, those that are certainly more interest rate sensitive to higher rates, really saw the brunt of that. When we think about some of the geopolitical issues going around, certainly that didn't help financial markets as well. And what we're seeing in Europe is clearly having some consternation in terms of financial markets performance, just the uncertainty as it relates to what that might mean for stability in Europe. At this stage, we don't see that what's going on there is going to impact central bank decision making, particularly in the US, but certainly as it relates to broader market investor nervousness, that certainly showed up in other parts of the market throughout the course of January, and it certainly hasn't helped the situation as we're into the middle part of February as well. And we believe that that sort of instability is going to continue to drive markets over the medium term. Domestically, we're heading into the February reporting season, first half reporting season. And again, from our expectations, we're not envisaging the same performance that we saw through the first half of 2021 is going to be repeated by any stretch of the imagination. Earnings growth is likely to moderate given where it's come over the last 12 months. That said, we do expect to see some reasonable results from some of the more quality names that we have across our portfolios, such as Macquarie Group, James Hardie, and the like. And we do believe that obviously on the commodity side, which has obviously enjoyed a very strong last 12 months, we expect that also to translate into some good performance numbers across some of the major miners on that basis. But January, by and large, was a challenging period for investors. We haven't materially altered our asset allocation over the course of the month. Again, as we've spoken about previously, we've looked to take risk off the table, and we've added some more defensive plays right across our portfolios. As I said, we're really just expecting that central banks are going to start to move in March, and that's going to be led by the US Fed, and that's going to have implications, no doubt, for financial markets throughout the rest of the first half of this calendar year. From an RBA point of view, we're still of the view that the RBA is going to take a more cautious stance as it relates to considering a rise in cash rates, despite the fact that obviously we have seen an uptick in our domestic inflation numbers. It's nowhere near as significant as what we've seen in offshore markets, and really, in our view, is probably at the upper end of that 2 to 3% band that the RBA is targeting. So we don't expect that should result in the RBA being overly aggressive in the way they position cash rates. That said, there's a potential for cash rates to rise through the back half of this year. As I said, that's not our base case. It does depend on how the inflation print looks through the second half of this year. But as I said, we think the RBA is going to take a far more cautious stance. So overall, a really challenging month for investors, beginning the calendar year 2022 after a very strong 2021. And we think this year is going to be one of those more volatile years, and certainly a more challenging year for investors. And as I said, from our point of view, we'll be certainly looking to manage the portfolios, reduce risk as much as we can, but focus really on quality within the construct of our portfolios as a basis by which we'll look to deliver returns going forward. As always, if you have any queries, please feel free to reach out to anyone on the team. And as I said, we look forward to catching up again next month. Thanks and bye for now.